What if I told you that the recent surge in gold and silver isn't just another bounce, not just another headline-driven rally, but a warning signal that most people are completely missing? Because while the mainstream is focused on stock charts and soft landing stories, something far more important is happening underneath the surface. Gold and silver didn't just rebound. They snapped back with force. And when safe haven assets move like this, it usually means stress is building somewhere in the system. The kind of stress that doesn't show up on your news feed until it's already too late. Over the last few sessions, gold and silver have both pushed higher after what many believe was a controlled pullback. But here's the thing. Controlled pullbacks don't reverse this fast unless something changes behind the scenes. And something did change. The Federal Reserve's tone shifted. Not loudly, not dramatically, but just enough for smart money to hear it. When the Fed signals uncertainty, even subtly, capital doesn't wait for confirmation. It moves first. And that movement is exactly what we're seeing now. Before we go deeper, take a quick second to like this video and subscribe to the channel. It helps more than you think, and it tells the algorithm this kind of honest market breakdown matters. You're watching The Silent Ledger, where we focus on what the charts, the signals, and the quiet money are really saying, not the noise. Now let's talk about what just happened. The rebound in gold and silver didn't come out of nowhere. It came right after renewed speculation that rate cuts may not be as distant as previously promised. The Fed didn't say we're cutting. They didn't need to. All they did was soften their language around inflation progress and economic resilience. And in today's market, that's enough. Because markets don't trade on what the Fed says today. They trade on what the Fed might be forced to do tomorrow. Gold reacts first because gold doesn't trust promises. It doesn't trust projections. It doesn't trust political calendars. Gold responds to pressure. And silver follows, but with more volatility, more emotion, and often more explosive upside. That's why when silver moves hard after a rebound, it's usually not retail money driving it. It's positioning. What's interesting is that this move happened while equities were still trying to act confident. That divergence matters. When stocks and metals rise together briefly, it often signals liquidity. But when metals surge because of fear while stocks pretend everything is fine, that's a warning phase, a transition period. And history shows that phase rarely lasts long. Safe haven demand doesn't spike for no reason. It spikes when investors start asking uncomfortable questions. Questions like, what happens if inflation reaccelerates? What happens if rate cuts come too late? What happens if debt servicing becomes the real crisis no one wants to talk about? These questions don't trend on social media, but they absolutely dominate institutional risk meetings. Silver deserves special attention here. Silver isn't just a monetary metal, it's an industrial one. And when silver rallies alongside gold, it tells us this isn't just fear, it's also expectation. Expectation of policy shifts. Expectation of currency pressure. Expectation of future stimulus, whether admitted or not. Silver hates uncertainty, but it loves response. And the market is starting to price in response. Another detail most people missed is how fast buyers stepped in after the dip. There was no panic, no extended breakdown, just a sharp rejection of lower prices. That tells you demand is sitting underneath the market, waiting. Not chasing highs, but defending levels. That's not how weak markets behave. This is where psychology comes in. Investors are tired. They've been told for years that inflation is temporary, that rates will normalize, that everything is under control. And yet costs remain high, debt keeps growing, and confidence feels thinner by the month. When trust erodes slowly, it doesn't collapse all at once. It leaks. And gold and silver are where that leakage shows up first. The Fed is trapped between two risks. Cut too early and inflation flares back up. Cut too late and something breaks. Banking stress, credit stress, government financing stress. Markets know this. They may not say it out loud, but they position for it quietly. And that's why safe havens don't wait for headlines. They move on probabilities. What makes this rebound more important is timing. We're entering a period historically known for volatility. Economic data becomes more conflicting, political pressure increases, and global risks don't politely disappear. Every time uncertainty rises, gold and silver reassert their role, not as speculative trades, but as insurance. This doesn't mean prices only go straight up from here. There will be pullbacks, there will be noise. But the character of the market has changed. The speed of the rebound tells us that lower prices are being viewed as opportunities, not warnings. That shift in mindset is critical. If you've been watching gold and silver from the sidelines, wondering why they refuse to stay down, this is why. Because underneath the calm surface of official statements, the system is under strain. And assets that protect against that strain are being accumulated, quietly, patiently. As we move forward, pay less attention to what officials say and more attention to how markets respond. Words can be managed, reactions can't. And right now the reaction is clear. Safety is back in demand. If this perspective resonates with you, let me know in the comments. Do you think this rebound is just a short-term move? Or are we seeing the early stages of something bigger? Your thoughts matter here, and I read the comments. Also, don't forget to share this video with someone who is trying to understand what is really happening behind these market moves. Most people are only shown the surface. The silent ledger exists to explore what's underneath. Thanks for watching, and I'll see you in the next one.